Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these beer money Sundays. I've got mine. I hope you got yours, whether it's adult beverage or otherwise. Thank you for being here. I love doing these every week or every week that I can. Just kind of an informal thing. Take off the bow tie and connect with you out there in the nation. So we're gonna get started. Let me know where you're coming to us from in the Bowtie Nation there in the chat. See a lot of you coming there. New York, Utah, Colorado, as far away as Germany, UK, Belgium. It's great to see everybody here every week. Just back from missed last week's live stream because I was in Miami to get my shot. So back fully vaccinated and ready to go. And great video for you this week, talking about something that I've been kind of struggling with myself, and I know a lot of you out there have been as well. Kind of where the market is going. Are we going to see some kind of a stock market crash or even stock weakness? Last week, the markets, NASDAQ and the S&P 500 closed down. First week in about a month that they actually closed down for the week. Big selling pressure there on Friday. So is this going to continue? And what are we looking at for stocks for the rest of the year? You know, the first half of the year was a crazy one, crazy good for stocks, really. Something like up 14-15% on the S&P 500, which is really double kind of the long-term average that you would actually expect from from stocks in any given year. So already had a big move to the upside in the first half. It's always a good time to start thinking about what the market isn't seeing that could change the picture. You know, what could change that dynamic and the momentum in stocks. You know, so we've got just starting the second quarter earnings reports coming out. Had the bank stocks reporting last week, which of course was very good. Expecting 65% earnings growth out of companies in the S&P 500 to report over the next few weeks. This week coming up, we see it broaden out quite a bit more to, tech. A lot of other sectors and industries are going to start showing, their earnings for the last quarter, for the second quarter. So it gives us a better idea, a more diversified look at the market and the economy. And again, overwhelmingly supposed to be very good, very high earnings growth. We've got low rates. Chair Powell at the Fed and really around the world, all the central bankers are saying we're going to have low rates forever pretty much. And stocks are pretty much priced all this in, priced for perfection. So what could go wrong, and really how do you prepare for that? How do you prepare for an eventual correction in stocks and whatnot? And understand that I think the market could still keep going on a lot of those factors. The really strong earnings growth, we are probably at peak earnings, which means that 65% earnings growth we're expecting for this second quarter earnings reports, it's not going to hold out. It's going to be more like 20% year-over-year earnings growth for the rest of the quarters in this year, the third and the fourth quarter. But those are still very good earnings growth. Interest rates may come up a little bit just on market fundamentals, but like I said, the Fed has committed to holding those short-term rates near zero. So a lot of reasons, a lot of support for the market. And bull markets don't die just because stocks get expensive. Okay, they need a catalyst. So what I want to talk about today is 3 potential catalysts that could come along and really derail that movement. Okay, so excited to get started. Do me a favor if you can. I've pinned in the chat call to just click that bell notification if you're a subscriber. Go to the channel homepage, click on the bell or the subscription thing. Make sure you've got the bell notification set for all. Lately, YouTube notifications have been getting really shady. Don't know if I'm shadow banned or if I pissed off somebody there at YouTube and they're not showing my videos to subscribers, but a lot of people have been saying they're not getting subscription notifications. So just make sure you've got that bell notification set for all, so you do get notified, and don't leave it up to YouTube to decide which videos you get shown. So we're going to cover that topic today, and then of course we'll leave room for Q&A at the end. Always my favorite part of the week is just talking back and forth, answering your questions there from they're out there in the nation. If you missed it last week, we got a great countdown video of high return investments that a lot of people hadn't heard of. So we started with some of the safest investments like the Series I bonds, which are really an amazing secret by the in the investment community. A lot of people don't hear about these because of course advisors don't earn any kickbacks or commissions from selling them. You buy them direct from treasurydirect.gov, and they actually pay more than twice what the risk-free 10-year treasury pays. So great way to to get a risk-free return. I'm going to go ahead and just ban someone from the chat here. But folks, if you're only here to pitch or promote your stock or your investment, then you're going to be banned there. That's not what we're here for. We're here for a smart a smart investing conversation, not to just pitch and promote your your stock ideas. Okay, but I want to get to it here because, like I said, this is an important topic, something that has been troubling me lately, and I know a lot of you out there. Stocks are at records. They are priced for perfection. It's hard to deny that. Okay, we're looking at a price to earnings ratio of around 30 times on trailing basis, and even 22 to 25 times on a forward basis. So that's counting in the earnings that are expected to be reported over the next year. Stocks are still trading at about 22 to 23 times that, which obviously is a very high number, much higher than about the 19 average over the last 10 years. So basically it's about a 63% premium on stocks on that price to earnings basis than we've seen over the last 10 years. So expensive relative to history. We're looking at those low interest rates pretty much forever. Okay, you're right. The Fed Chair Powell wants to say that inflation is just temporary, that he's going to hold, him and the Fed are going to hold low interest rates near zero till pretty much right now they're saying till 2023. Okay, so think about that. We've got an economy suspected to grow 7% this year. Unemployment's coming down. Employment numbers are good. Inflation is going up. And yet the Fed still doesn't want to raise interest rates until 2023, more than a year into the future, which is really just kind of setting up the stock market for a big letdown when they finally do start raising rates. Economic growth is strong. Earnings are really amazing. So stocks are pricing all that in. And again, there are still plenty of reasons for support. Stocks don't crash in a year when you're going to get 7% economic growth. Okay. Stocks don't crash when you've got 0% interest rates and pretty much free money. Okay, there is a tremendous amount of liquidity in the market. Household savings are over $1.5 trillion in the U.S. alone. Okay, so J.P. Morgan estimates that households in the U.S. have saved up an additional $1.5 trillion, more than what they would normally have. Over the last year and a half during the pandemic, they've saved up that money because of all the stimulus, because they didn't have anything else to spend it on, and now they're finally getting out and spending that. So it's really hard to see any kind of a deep stock market crash, in that environment. But like we said, all it takes is a catalyst, because stocks are undeniably expensive. They are priced for perfection. So I want to talk about 3 catalysts that I'm looking for, kind of the odds of each, and how to protect yourself in those, and just give you something to watch for. This doesn't mean when the market opens up tomorrow, sell everything or hedge or buy tons of protection, because I do think that support can maintain. Basically, if we do get any kind of a correction, it's just going to be just a 5 or 10% correction downward in the stock market. Obviously, if you're invested completely in tech or some of those high growth names, that's going to mean a little bit bigger fall, sell off for those, like we saw in March when the broader market, so the Nasdaq lost about 10% at the worst point there in March, but a lot of those growth names, a lot of those disruptive stocks fell 20, 30, and 40%. So be watching for that. But I don't think it's going to turn into a full-blown stock market crash unless we see something like this, something like one of these 3 catalysts that we're watching. So, and the first one is just going to be a quick increase in interest rates, like we saw in February or March, where basically the 10-year Treasury rate on the 10-year Treasury started the year at 1%, right? Just under 1% at the end of last year, boomed to 1.75%. So 75 basis points higher in the 10-year Treasury rate within 2 months, really, which 0.75% might not seem like a whole lot of an increase, but for interest rates, for treasury rates, that is ginormous. Okay, you just don't see that kind of move. And of course, that's what caused that big correction, stock market correction there in late February, early March, causing those stocks to come down 10% on the NASDAQ and 20, 30, 40% in some of those high growth names. As well as this is kind of a twofer on this catalyst, kind of that inflation longer term idea. Now, lately we've been seeing just runaway inflation numbers. The consumer price index is up something like 5.4% over last month, reported 5.4% over the last year. Continues to surprise on the upside. The PCI, the consumption index, which is closer followed by the Fed, was also up surprisingly high. And yet the Fed still keeps on saying, and most economists are saying, that it's temporary, right? We're after this year, we're going to get back to lower inflation of around 2, even as high as 3%, but no higher than that. Yeah, and the market seems to be giving them, buying them at their word, right? Giving them the benefit of the doubt. The market is not selling off. It's not pushing interest rates higher on this inflation because it does believe it's going to be short term. Well, what happens when it keeps on going? We keep on getting higher inflation numbers, and I think this is where you start seeing, wage inflation, wage growth come into play there, pushing inflation up higher, and just kind of trickling through the system. And right now, there's just huge liquidity at banks, and really everything around that is holding those rates down, and the temporary inflation narrative is holding. But what happens though is, once we get into really into September, October, and November, if those inflation numbers are still higher, then we're going to start seeing. We're going to start seeing investors question that temporary inflation narrative, right? And that's when you start seeing interest rates rise. As we see the employment picture pick up, we've had a few really bad unemployment jobs reports over the last few months, but they've started to pick up. As that starts to pick up, I think you start seeing interest rates rise, and that kind of throws a wrench into this. So, and of the three scenarios that we'll talk about, these three catalysts that can derail this market and lead to maybe a larger stock market correction or even into a crash eventually, this one is probably the most likely, right? Now, this isn't 100% that it's going to cause a crash, but it is pretty close to 100% that some parts of this are going to are going to weigh on the market, right? We're going to get a little bit higher inflation. Gradually, people are going to start questioning that narrative that inflation is going to be temporary, because I do believe there's a lot of pieces of inflation here that aren't being accounted for in the market. That all you got to do is go to the grocery store. All you people out there, inflation is a lot higher than they're talking about in the numbers. That core good food inflation number, a lot higher if you're going out to grocery shopping, right? We haven't quite seen the wage inflation growth that I think is coming. Employers are fighting for new employees, fighting to get people to come back from those that remote work and stay at home and that kind of thing. And it's going to translate into higher wages, right? Higher wage growth. That hasn't hit the inflation numbers yet, but it soon will. It soon will over the next few months. And I think that's really going to feed into that inflation longer term picture, right? So we get this idea that there is still some payment, some bill to be paid on these higher interest rates and inflation. The Federal Reserve, Powell and the rest of the Fed are expected to give a clear path to how they're going to pull back on some of this support. The Fed is still pumping in $120 billion every single month into the market, into the economy, right? They're buying mortgage bonds, they're buying and they're buying treasuries, right? So obviously when they buy those mortgage bonds, when they buy those treasuries, they push cash out in the market, and they're still doing that to the tune of $120 billion a month, right? And that's a lot of what this is supporting, this all the money into the system, all the liquidity at banks and that kind of thing. Well, it's expected when they meet for their Jackson Hole yearly roundup there in August that they're actually going to talk about, okay, when are we going to start pulling back on some of this $120 billion, right? They're expected to start saying, okay, you know what, we're going to start it in, maybe January of next year and gradually take off each month, maybe 10 or $20 billion worth of this support each month to pretty much end it towards the end of next year. Okay, well, the thing is, as we start seeing those inflation numbers remain high, they're going to have to change that idea. They're going to have to maybe take that support off a little bit faster, right? And that's really where you're going to start seeing the weakness in stocks on these interest rates, on this inflation. Okay. Now again, just on the basis of stocks being expensive, stocks priced for perfection, that doesn't necessarily mean stocks are going to fall. What you have to get here is a catalyst, something like this, where people start questioning that temporary inflation narrative, where interest rates do start heading higher, and that's when you start seeing that sell-off, the correction of 5-10%, and if this one gets bad, it could get even higher to 15 or 20%, especially in the tech, internet, and biotech stocks. Okay, that's really where you got to worry about with this particular catalyst. Okay, the interest rates, and the longer-term inflation. And those two are really tied, okay? As we see inflation rise, then you're going to see interest rates rise along with it, because, if inflation is going to start eating away at the payments that people receive on their bonds, on their fixed income securities, then they're going to demand a higher interest rate. That's just how it works, how that market dynamic works. So you're going to start seeing interest rates rise, and a lot of these stocks, these growth stocks, these momentum stocks, tech, internet, and biotech, that are really priced for their future cash flows. As the interest rate increases, those future cash flows become worth less now in the present. So you see the same thing, really what we saw in February and March of this year. Interest rates rise, those stocks get hit the hardest. What you want to look for probably for some safety in these would be in financials, materials, energy stocks. And again, that's basically just kind of a return to that Q1, that first quarter market that we saw. Okay, financials, bank stocks, even insurance companies, things like that benefit as interest rates rise, because the banks can loan out that money at a higher interest rate. The insurance companies can earn a higher return on their cash savings, for those policy premiums that they collect. Materials and energy sectors stocks are really tied to commodity prices that will do well in inflation and as interest rates increase. So that's really the first catalyst that I'm looking at that could disrupt the market momentum and send stocks lower. Again, probably not the worst catalyst that we'll be looking at today. These other two catalysts probably send the market down quite a bit more, but this is probably the most certain. We are definitely going to see higher inflation. We're going to see higher interest rates. It's just a matter of how bad it gets and how much it affects the market. So want to take the third one. I'm going to take these out of order here because I want to save the other one, the second one, for last. The third one here, the second catalyst that we'll talk about, is really just a virus mutation, right? And that's basically, we're talking about the COVID vaccine or virus, okay, mutating to a point where the vaccines, aren't effective anymore, okay, right? Where you need another vaccine to protect you against that new strain of the virus. And this happens all the time, right? This is why you have to get a flu shot every year, because the influenza virus mutates, right? It changes a little bit each year. Different mutations, different strains of it change to where old vaccines that you had aren't effective anymore, whether they've worn off or whether they're just not effective against that strain. Okay, so that happens all the time with viruses, and it will eventually happen with the COVID-19, right? What we're seeing right now is that Delta variant that is basically the causing the surge all around the world. I think U.S. cases for COVID right now are up to, I think they were like 40,000 on Friday, up from, they hit a low of 11, 12,000 just a few weeks ago. So that strain is obviously much more transmissible, hitting a lot of people that aren't vaccinated yet, and causing a lot of concern that they're going to have to lock down and put more restrictions on. I know California, I think, just reimposed their mask mandate. But it's still, the vaccine is still effective against that variant. But what happens though, and this is where you have almost 100% probability that this virus is eventually going to mutate into something that the vaccine is not effective at, because there are a lot of countries out there that just aren't vaccinating people nearly at the rate they could or need to, right? The U.S. is something like a 50% of the population vaccinated. I know UK is very much higher than that even, and across Europe is really doing well on that vaccination progress. But a lot of countries, here in Colombia, where I'm at right now, they just don't have any vaccines. Okay, they sent people, the Colombian government sent people to negotiate for those vaccines to, Pfizer and Moderna and all those companies to get vaccines ahead of time. But they forgot to send anybody that spoke English. So yeah, they just don't have any vaccines here. My wife's vaccinated because she's a nurse. I'm vaccinated because I flew to Miami to get mine. But there just aren't the vaccines here in Colombia or across a lot of countries, right? So what you have, is you've got the vast majority of the global population is not vaccinated, is getting these different strains of COVID-19, right? The Delta variant, all the different variants and the mutations of this. Well, so you get somebody that gets a variant. Okay, let's back up. They created Pfizer, Moderna. They created that vaccine against the COVID-19, right? But then you get all these people that have different mutations of that virus, and then they get mutations of the mutations, and that those strains just keep on mutating until eventually, one is a dominant strain, and it's so far removed from what the vaccine was built on. The vaccine just isn't effective, okay? And you've got billions and billions of people acting as host bodies, for that virus to mutate and change. We're going to get one eventually. We are going to get a COVID vaccine or a COVID strain that is resistant to the vaccine. It's just a matter of when, okay? Now, this is one of those that, probably won't happen this year. It's very much unlikely that it's going to happen this year. It takes a while for those strains of the strains to develop. But epidemiologists and experts there, and this was like 6 months ago, I was reading this, they were estimating, anywhere from a year to 18 months. They were predicting that we would get a strain of the virus that was resistant to the vaccines. So, that still gives us into 2022, maybe 2023 when this happens. This would be a higher sell-off than that first catalyst that we were looking at. Obviously, this would, even the headline that there is a strain out there is a variant out there that is resistant to the vaccines, is going to be a shock to the market. It's going to be a headline risk to the market. Okay, and so that's why you really do need to watch out for some of these consumer discretionary names, these stocks that were hit hardest by the vaccine. Okay, I know everybody likes to invest in the airlines and the cruise lines and the hotels and all the companies that are rebounding right now in this reopening. But you got to watch out, and you got to maybe buy some puts against those just in case we do get that big 10 or 20 or 30% sell-off in those, because while I do believe the the vaccine makers, Pfizer, Moderna, all those, while I do believe they are going to be faster at developing a vaccine for any kind of a strain, a resistant strain, so we're not going to have to wait a year for a vaccine again. But it is still going to be a headline risk, and it is still going to mean some kind of increased lockdowns or social distancing and that kind of thing. And especially a lot of these, like we were talking about, a lot of those stocks that were hit the hardest, the airlines, the cruise lines, the hotels, and things like that. It could make it very difficult for some of them. I'm thinking specifically of the cruise lines, okay, because the cruise lines still haven't gotten back to full capacity, right? Just saw one in Asia last week that the people were locked down at like 3 a.m. in the morning. Somebody tested positive for COVID. They locked the entire ship down and then had to disembark everyone in Singapore the next day. So basically canceled that ship for one person that had COVID. Okay, and that's something that those cruise lines, they're just going to have to live with. But if this happens, if this vaccine resistant strain comes up and hits them, there's going to be a lot of cruise lines that are going to be bankrupt. Okay, just telling you that they are totally overburdened with debt right now. Earnings are going to be years and years before the earnings are positive again. And when we do see a COVID, another strain of COVID and any kind of lockdowns or any kind of restrictions on sailing for those cruise ships, for those cruise lines, someone's going to go bankrupt. They're not going to be able to survive another lockdown of those. So that's really the second catalyst. Again, not as likely as the first one, but probably a higher sell-off if we do see it. Now the third catalyst I want to talk about, and this one is much less probable, but probably the biggest effect on the market. And this is something, if we see something like stable coins breaking the buck. Okay, and what this is talking about here is the little known cause of the 2008 crash was the breaking of the buck in the money markets. Okay, money markets, they were supposed to hold their value at $1 each, per share, right? So when those, and they invested the money in super safe commercial paper, right, as overnight loans to companies, things like that. Well, when the value of those funds, those money market funds, fell below $1, which was really thought to be impossible. Okay, they were supposed to be so safe, so secure, those money market funds, that when they found out that the reserves they were holding for those in those money markets, the commercial paper reserves, were not enough to support that $1 each, right? And this was such a shock because these were supposed to be extremely liquid, extremely safe investments. It just caused a mass exodus, mass selling that turns into a crash. And this is really why we saw the deepest and worst part of that 2008 crash, the Lehman Brothers bankruptcy and that kind of thing, is because the money markets broke the buck. Well, this is kind of eerily similar to what we're seeing in stablecoins right now, right? Stablecoins, if you don't know, stablecoins are a digital currency, right? But unlike Bitcoin or Ethereum or a lot of those other ones that have really big volatility in the price, stablecoins are supposed to be stable, right? They are pegged to the dollar. So a lot of these, the USDT, the Tether, the USDC, they're supposed to be pegged to the dollar and be $1 each, right? $1 per token. And that's something that's supposed to be inviolate, right? They are supposed to be backed up by reserves of dollar. They actually came out and fessed up to really not being 100% backed by dollars. It used to be everybody thought, okay, well, it's so completely supported by dollars, so that dollar per stable coin shouldn't move. While recently they've gotten a lot of pressure to show what they actually hold in their reserves for that. And a lot of it is in commercial paper, just like what we saw with the money markets. A lot of it is in, other short-term assets, right? So it's not necessarily as safe as, a lot of people would like to believe, right? Again, and I think, they found that, there's such demand for stablecoins right now. They found it's something like 1/5 of the commercial paper market. Right. So if we see any kind of a sell-off in commercial paper or any of these other things, if stable coins break the buck, and do it measurably, stable coins, they do fluctuate to like maybe it's a $1 and 1.0003 or 0.99994. Okay, so they do fluctuate by 1/100 of a cent or something, but they don't fluctuate that much. If they do that significantly, if they fluctuate and go down to like 0.97, there could be another massive sell-off in stablecoins that is actually going to lead to a lot of defaults and liquidity problems in that commercial paper market as well. And of course, this is why we see, Treasury Secretary Yellen this week. She said that this week she's going to pull a whole bunch of people together and talk about regulating the stablecoin market and what they can do. And I mean, and that's actually a good thing. They really do need to be watching this market. Make sure that they have those reserve funds that are supporting that $1 per token or $1 per coin. Because yeah, if they break that buck, then that could be a huge catalyst to a sell-off, not only in stablecoins, not only in digital currencies, but across the wider economy. Okay, because these are very much being used leverage to buy these and do different kinds of things with these stablecoins. Again, this is probably the least likely of these three catalysts, but a very real risk and would obviously be the most catastrophic. Think September 2008 when Lehman collapsed and took the market down 40% over the next 2 months to mid-November. During that crash, that would be what this is. What this would be more like. Okay, so just something to watch there. Okay, I want to turn this over to the Q&A.